Now, the big retailer Macy's came out with their earnings the other day, and things don't look too bright. Now, that stock took a pretty big hit and is now at a 52-week low. But the main takeaway from their earnings was the top executives stating that Macy's credit card balances are bloated and their credit card holders are up to the limit and they have no more money to spend. And in the second quarter, Macy's credit card sales tanked 36% from a year earlier. And this is going to be a problem going forward for retailers as the consumer is simply out of money. With credit cards up to the limit and the average Joe just barely getting by, kick in the return of student loan payments, and things look pretty ugly going forward, especially this holiday season. Now, the average interest rate on a Macy's credit card is about 32%. And can you imagine just having a few $1,000 balance on one of these cards? I mean, these terms are basically loan shark, mafia type fees, and I don't see how anyone can get from under that. Now, this is a quote from Macy's chief financial officer. These bad debt assumptions and write-offs are the result of rising delinquencies, which lead to higher net credit losses over time and contribute to increased bad debt within the portfolio. So there you have it, folks. These delinquencies, people getting behind on their credit cards, all of this is piling up, and the retail sector is headed for a disaster. I mean, perhaps the retail sector can hold it together through this holiday season, but after that, it's going to be a bloodbath. Now, Macy's stock is around $12, and that's kind of comical because I'm not sure there's anything in Macy's that you can buy for $12. And about 18 months ago, this stock was near $40 a share. Now, Apple came out with their earnings a few weeks ago, and it was their third consecutive quarter of sales declines. So everyone's feeling the burden of a slowing consumer. Now, sticking to retail news, Foot Locker stock plunges 32% as sneaker retailer blamed dismal results on consumer softness. And consumer softness is in quotes. And Foot Locker sales fell 10% year over year. So this is just more proof that the American consumer is spending less. Now, many of these retail stocks have been taking it on the chin these last 2 weeks, and there's still quite a few earnings from retailers this week, but many of these stocks are at 52-week lows. Now, existing home sales have fell to their lowest level since 2010, and this is no surprise with mortgage rates where they are and the savings rate where it is. The average Joe on the street just can't afford a home. And as we go into the fall and winter months, I expect that number to grow even worse. Spend, spend, spend. The U.S. government has already spent $5.3 trillion this year. And it looks like this year will be the fourth consecutive year where the government spends more than $6 trillion. And all in all, that will equal more than $25 trillion since the year 2020. Now, to put that into perspective, the market cap of the S&P is around $37 trillion. So this country has a spending problem, and it doesn't look like it's going to stop. And that has all kind of ramifications down the road. Now, staying on the topic of debt in this country and the ramifications of our growing debt, here's a story. The Shanghai-based New Development Bank, led by the BRICS Economic Coalition, is focusing on de-dollarization with plans to reduce dollar-denominated lending. It is focused on the use of BRIC currencies such as South Africa, Brazil, and Indian tenders. So we're seeing more and more stories of many countries across the globe kicking the dollar to the side. Now, it's not something that's going to happen overnight, but the worth of the dollar is shrinking. Less and less around the world is the dollar being accepted. And what's that going to be like 5 or 10 years from now? So this is very troublesome. Now, S&P Global has cut credit ratings and revised its outlook for multiple U.S. banks, warning that funding risk and weaker profitability will likely test the sector's credit strength. And just in the last couple of weeks, if you look at many of those regional bank stocks, they're slowly dripping back down to those 52-week lows. So I'm not so sure that the regional banking crisis has been resolved. And I have a feeling before this year is over that we're going to be revisiting those negative regional bank headlines.